But here, I just wanted to bring back this chart again, and I just wanted everyone to again relook at the number of acquisitions and the scale of acquisitions these companies are doing. So typically, M&A is an event, right? It happens maybe once in 3 years, maybe once in 5 years, even for these large companies. But when a company does so many acquisitions, 5, 10, 30 acquisitions every single year, is it really an event? No, right? It should be the part of the process for the company. And as an outsider or as an analyst, this raises so many questions. Firstly, how do these companies even manage their integration risk? Because they're acquiring so many companies year after year. Good evening, everyone. So, before we begin, please take down the dates for the upcoming FOF sessions. So, the next FOF is on Feb 19th, followed by March 12th, and then April 23rd. So, the topic for today's discussion is successful trades of programmatic acquirers. So, these are essentially companies that use M&A as a core and repeatable part of their growth strategy. And the M&A playbook they have as well is quite unique. So, there are many of these programmatic acquirers listed in the global space, and we'll be taking a look at a couple of them today, especially in the industrial sector. And what's interesting is that some of their trades, they're also visible in some well-known Indian companies. So we'll be taking a look at that as well later today. But before I start talking about frameworks or trades, I just want to start with one simple observation. Many of these industrial programmatic acquirers, they operate in these B2B industries where they make a specialized component or a specialized product, and the cost of failure of these products are multifolds in compared to the cost of the product itself. So let's first look at some examples of such industries and see where these acquirers even fit in. So one such example of an industry like this is the aerospace industry, right? And when we think about the aerospace industry, we think about the large visible components, be it your engines, your wings, the fuselage, and so on. But these large visible components are made up of hundreds and thousands of tiny subcomponents. And many of these components, they have to be replaced by the airline operator routinely in order to maintain any regulatory requirements or safety requirements. So those bag of seal springs that we see there, it's one such aftermarket critical component which is sold by a well-known player in the sector. So at first, that bag of parts, it may look very trivial, but it may cost as much as a mid-range BMW or a Mercedes. So that's the level of criticality we're dealing with here today. And what's interesting is that the company that makes these components, they also operate in a much more harsher environment, which is space. So two subsidiaries of this company, they actually supplied components to the Chandrayaan space programs. Your customers, although they may be different, be it civil aviation or space, the requirements are the same, right? Neither of them want any failure because failure can lead to disasters in any of these segments. So let's meet the company that is behind all this. The company is called Heiko. It's a $50 billion market cap company, and it's the largest provider of generic spare parts in the commercial aviation space. And it's also a component maker for specific space programs as well. So whether it's an unmanned mission to the moon or whether it's an unplanned last minute flight, Heiko plays a role in both of them. So let's look at an example of another industry. So can anyone here tell me what's common between a semiconductor chip and a potato chip? So the answer is actually air or the lack of air. A semiconductor chip, it has to be made in an air-free or a particle-free environment. But a potato chip, it has to be packaged with the help of compressed air or compressed nitrogen. So that's the breath of fresh air that we get when we open a large packet of Lays. So let's meet the invisible machines that is behind all these things. So tucked away somewhere in the utility room of a semiconductor chip making facility is your vacuum pump. And the whole job is to make an air-free or particle-free environment over and above which your lithography machines and your other semiconductor equipments can actually operate on. Similarly, tucked away somewhere in the utility room of an FMCG facility is where you would find an air compressor, which delivers food grade, industrial grade air to the packaging facilities. Again, both the customers are different, right? But the requirements are the same. Neither of them want any failure because when these machines fail, it can lead to production downtimes, which can cost even millions of dollars. Now let's meet the company that is behind all of this. The company is called Atlas Copco. It's a Swedish company with a market cap of nearly $100 billion, and it has nearly one third of the market share in industrial air compressors and more than 20% market share in semiconductor vacuums. So every time you open a packet of chips or every time you upgrade your smartphone, you're quietly paying a company like Atlas Copco. Now, what's interesting about these market leaders like Atlas or Heiko, it's that they operate behind the scenes across multiple critical industrial processes, right? And while doing so, they generated extraordinary wealth for their shareholders. You can see that over the last 20-25 years, they have also significantly outperformed the S&P 500. And the large part of how they became a market leader in the first place is due to acquisitions, and not just one, two, or three acquisitions that completely changed how these companies grew. It's by acquiring companies year in and year out, and multiple companies year in and year out. So, if I look at Atlas, for example, which is the light blue bar chart, they've acquired more than 250 companies over the last 20 years, and nearly 20% of their overall growth has come from the inorganic route. Whereas Heiko, they've acquired around 79 companies over the last 20 years, and nearly more than 60% of their overall growth has come through the inorganic route. Interesting, right? But when I look at so many acquisitions, especially so many acquisitions every single year, I'm reminded by this quote from Peter Lynch. So Peter Lynch said that if a company must acquire something, he would prefer it to be a related business. But acquisitions in general make him feel nervous. There's a strong tendency for companies that are flushed with cash, feeling powerful to overpay. They end up expecting too much from these acquisitions and they end up mismanaging them. So those last three exact things that he talks about here are precisely the reasons why many large M&A deals that we have seen in the past would have looked very attractive on paper, right? But the outcome would have been something else altogether. Say, for example, AT&T's deal to buy Time Warner back in 2016, which is a very big media deal back then, or Daimler-Benz's acquisition of Chrysler back in 1998, another famous deal in the auto sector. Now, both these deals, it made so much sense on paper, right? Daimler, for example, they were getting access to the mass American market through Chrysler's branch, and Chrysler was getting access to high quality German engineering and luxury brands through Daimler. And in AT&T's case, AT&T had the vast customer network. It had the vast distribution strength. And this is something, someone like a content powerhouse, like a Time Warner could actually leverage off of, right? But fast forward a few years, the outcome was something else. Both these acquirers had to actually let go of these businesses. So there are many such cases like this where initially the the synergies were overestimated, but the cultural mismatches were completely underestimated. For example, if I take Daimler's case, the quality at any cost engineering mindset the Daimler engineers came from, it didn't match the low cost manufacturing prowess which Chrysler had. And eventually, this led to a lot of delays in decision making, and these companies had to part ways. So even if we look at India, the famous deal, which is Tata Steel's acquisition of the Chorus Group back in 2007, this was a highly leveraged transaction that Tata Steel had done. And while doing this transaction, they were also engaged in a bidding war with the Brazilian steelmaker, which also drove up the valuation multiples. Again, this deal made a lot of sense back in 2007 because the Chorus Group was a well-known value-added maker of downstream steel products in Europe, but it didn't have access to low-cost coal or low-cost iron ore, which is something Tata Steel had back in India. Again, so made a lot of sense, right? But again, if we fast forward from 2007 to 2016, 17, Tata still had to write off more than 60-70% of the asset value that it had acquired. So when we read about all these cases, we might ask, right, what makes these programmatic acquirers different, or what really sets them apart? So let's look at their acquisition playbook. Firstly, these companies, they come with a self-finance acquisition engine, meaning that most of their acquisitions are funded through their own internal cash flows. Typically, when they do take debt, the leverage levels are also under control typically. And when the cash is, let's say, ready for acquisitions, they don't go for these large, big bang acquisitions, which are, a significant percentage of the market cap or capital employed. They go for these multiple small, profitable, privately owned businesses. And in many cases, these privately owned businesses are either family owned or owner operated. So I'll get to why this is even important in later slides. And what's more interesting is that when they acquire these businesses, they allow them to operate independently. Again, strange, right? Because we just saw those large global brands that were, running for synergies, chasing after these synergies. And here there is someone saying that these companies are, acquired and are allowed to operate independently. And of course, the next step is to repeat this entire process and use the break cash flows to fund the next deal. Now, this playbook is very well captured in these two books. One is the compounders, and the other is the acquirers, the outsiders. And these two are very good books on how these programmatic way of acquisitions tend to happen, and how it has benefited some of these companies. Again, and I'm not saying that it's the only way to do acquisitions or the only right way to do acquisitions, but having such a structure has definitely helped these programmatic acquirers. So there are many such companies like this, and if I zoom into the industrial space, apart from Atlas and ICO, there are other companies like Amtech, who's also a specialized component maker, or even Amphenol, another specialized component maker, and even Transcend in the aerospace sector itself. And if I zoom out and look at other sectors, there are also companies like Danaher, which my colleague Abhishek spoke about in the November FOF. So they have also grown a lot through these programmatic way of doing these acquisitions. So today I'll be talking about two specific industrial companies, which is Atlas and Heiko. So let's take a look at the first part of the equation, which is the self-finance, the M&A engine. So I broadly talked about this before, so I'll just go through it again. ICO is a mission critical component maker for in the aerospace sector, and they cater to these airline operators and these maintenance facilities. And like I said, many of these components they have to be routinely replaced by the airline operator based on the number of flying hours or number of takeoffs and landings and so on. And this constant replacement cycle creates this recurring demand for a majority of these products. And all the benefits of this can be seen in their cash flow numbers. So if I look at their EBITDA, they convert around 75% of their operating income to operating cash. They convert more than 100% of their PAT into free cash. And pretty much all of this free cash is being thrown into acquisitions. So again, given the good cash conversion and cash position, there's not much requirements for debt, right? Similarly, if you look at Atlas, they try to solve for this problem through a different way, which is your classic razor and blade approach. So they sell that one-time equipment or your semiconductor vacuum or your air compressor, and they monetize this through a recurring stream of blades, which is your consumables, your services, your long-term service agreements, and so on. And the benefits of all of this you can again see in their cash flows. More than 70% of their EBITDA is being converted to operating cash, and more than 95% of their PAT is being converted to free cash. And one third of all of this is being thrown into acquisition. Again, a healthy cash conversion, so not too much requirement for debt, right? So let's now look at the second part of the equation, which is M&A. So here I just wanted to bring back this chart again, and I just wanted everyone to again relook at the number of acquisitions and the scale of acquisitions these companies are doing. So typically M&A is an event, right? It happens maybe once in 3 years, maybe once in 5 years even for these large companies. And when these large M&A deals happens, there's a whole bunch of bankers that are involved that come and do these commercial due diligence and financial due diligence. There's also an army of consultants that are appointed that draw out a well thought merger integration plan, and they give step by step guidance as to how to integrate the acquirer acquisition target into the acquirer. But when a company does so many acquisitions, 5, 10, 30 acquisitions every single year, is it really an event? No, right? It should be the part of the process for the company. And as an outsider or as an analyst, this raises so many questions. Firstly, how do these companies even manage their integration risk? Because they're acquiring so many companies year after year, right? Secondly, how do they even manage the operating mismatches in operating style? We saw this go wrong in the cases of Daimler, for example. And these companies that we spoke about, they allocate capital at a global level. So there's bound to be some mismatches when you're acquiring multiple companies globally, right? And most importantly, what about management bandwidth? I mean, if you're acquiring so many companies every year, does the management even have time to run the core business and also focus on M&A? And lastly, is this entire process even repeatable, or how is it even repeatable? And the answer to all of these questions is kind of surprising. It extends beyond just well thought out strategy or well thought out planning. It comes down to the operating culture of these companies. And that's the heart of all of these programmatic acquirers. And that's also the heart of today's presentation. So here I just wanted to reference this book, which is Berkshire Beyond Buffett. And as we all know, Berkshire is a well-known serial acquirer itself, right? It has hundreds of operating entities across sectors, uh, energy, manufacturing, consumer goods, railways, etc. But all these operating entities on the surface, they may look very unrelated or extremely diverse, but they're all linked together through group or cultural values. And that is exactly what this book talks about. It talks about the cultural values that brings Berkshire together and keeps the engine running. So I've just brought it down to the book talks about around 9, 10 cultural traits. I just brought it down to four, which I felt was relevant for today's session. So firstly, it's the hands-off management rate, which we all know when Berkshire goes and acquires a company, they don't meddle with the day-to-day operations of that business, right? They want to give as much as autonomy and as much as P&L responsibility as possible, and delegate all this autonomy down to the operating entities itself. Another common thing you would have heard of when while reading about Berkshire is the idea that they acquire a lot of family-owned or owner-operated businesses, which is captured in the point kinship. So even your famous names from Berkshire like Seas Candies or NetJets or Nebraska Furniture Mart, they're all either owner operated or family owned. And we have read that many times the incentives for these family owned businesses, for example, for them to sell would be just beyond price or getting the right valuation. They would be worried about the legacy of the family. What about the brand? In a way, a lot of these family owned businesses, the name would be attached to the brand, right? So they'll be very picky to who to give their brand or in a way the legacy to. Another aspect is captured in the point eternal, which is the idea that Berkshire provides a permanent home for these businesses. They don't buy it with the intention to just flip it, right? Then the whole idea of providing stable ownership is also an attractive feature when we talk about Berkshire. And lastly, investor savvy. I think that is already well spoken about when it comes to Berkshire. But of course, when you're throwing so much of your cash into acquisitions, you have to be pretty savvy about it. So let's talk about the first trait, which is the hands of cultural value. So, like I was saying, when we think about Berkshire, they have multiple operating entities, hundreds, right? And this will have more than even more number of operating subsidiaries. When we put all these subsidiaries together, Berkshire ends up employing around 300 to 350,000 plus people. But the headquarters of Berkshire, it hardly has around 30, 35 people, including Buffett. But this is again not very difficult to understand because Berkshire's job or Buffett's job at the headquarters is to focus on finding the right people or the right company or the good investments, right? In a very similar way, this is how these programmatic acquirers also run. They have a very decentralized structure where you have the lean headquarters in between, and surrounding it, you have these autonomous, independent business units. And in the case of these companies, it would be their own business segments, the various business segments. So if I take Atlas Copco, for example, earlier we saw that they have a vacuum segment and a air compressor segment, right? So compressor would be a large blue box, and then the vacuum segment would be a large blue box. This would be further divided into its own subdivisions. For example, there could be an equipment side of things within the business unit, or there could be a services side of things for the business unit. So given that they all operate independently, or there's a lot of autonomy that the headquarters gives to them, these business heads of these units, they almost act like mini CEOs that are surrounding these companies. So when the whole idea is that, let's say if there's an issue that comes up in one of the subdivisions, like the red circle there, the idea is that it should be settled then and there, rather than going through multiple layers of management and getting the headquarters involved, which actually delays a lot of decision making, right? But why does all of this even matter from an M&A perspective? Firstly, that decentralized structure, it may actually be very attractive for a lot of acquisition targets. Let's say if there's a owner operator who wants to sell a major portion of his business and wants to join a larger platform. There would be the first worry would be that they might lose out on the decision making or autonomy that they're getting in a smaller business. But if they see such a decentralized structure, they may think that they may benefit from having such autonomy and such decision making power, even when they join a much larger industrial platform, which would benefit them in both the ways. And another important thing is top management, the bandwidth issue that we spoke about. Now, when all the operational responsibilities have been delegated downwards, the top management's bandwidth is preserved for long-term strategy and especially M&A. So this leads to cutting out a lot of the middlemen in the process. And these companies, these acquirers, they tend to have in-house due diligence expertise, in-house deal sourcing expertise as well. So it's actually pretty interesting that these companies, 70 to 80% of the M&A deals that they do, it's all sourced through their own internal deal pipeline, and they're not reliant on bankers or consultants. So let's see how this deal flow pipeline actually even works. So like I said, these companies operate with multiple business units and in turn multiple different business segments, right? And in a way, these subsidiaries, they act like a scouting network for these acquirers. They go out and find these acquisition targets, and if something is interesting, they would relay that to the top management or the whoever is in charge of acquisitions in these companies. And all this happens in the normal course of business. So I'll just read out this quote from Larry Mendelson, the founder and the long-term CEO of Heiko. He said that many of our acquisitions are a result of our subsidiary operations, either getting to know a supplier or a competitor or someone in the industry over a long period of time. And they end up developing these strong relationships with them. So even before they go and acquire these companies, they spend about 5, 6, 7 years trying to get to know the company. They build very strong relationships with these companies. And when the time to sell comes when the time to sell these acquisition targets, the companies like Heiko and Atlas, they want to be the first call for these companies. So this is where making such long-term relationships. This is where it actually helps these companies. Now, why does all of these things matter? Firstly, it's the qualitative insights that someone would get through the entire process. It's much more, right, as compared to what someone would get if they go through a third party due diligence or anything like that. Another key thing is that they can actually avoid bidding wars. I mean, if you're spending so much time, 5, 6, 7 years, trying to get to know a company, understanding them, it's very likely, or the chances would be very low, that they would actually go out and shop for a better valuation or a better price when the time to sell comes, right? It's likely that these programmatic acquirers could be the first call for these companies. And lastly, it's cultural alignment. And we saw how cultural mismatches can lead to, or destroy a lot of M&A deals. So when you're getting to know someone for a very long time, you know they would fit in or whether they won't, right? It's a very similar process here. And if these companies feel that these companies the acquisition targets can actually fit in the decentralized structure, the integration is also less cumbersome as compared to those larger deals that we saw. So this plays a very key role in how the M&A deals work. So the next trade I want to talk about is kinship. And here I'll just give an example. Let's say there are two types of companies. They're either a owner operator or a family run business. And these companies meet the basic requirements that these acquirers look for. They operate in the same industrial area where these acquirers are operating. They're profitable, they're cash generating, right? And it's built over decades, strong customer relationships, basic traits for a very good small business. But there are some concerns, and they're looking to sell these owners or the family reps. Growth could be constrained by capital or scale. And this is where they could use cash from a P fund, or this is where they could, it could really help if they join a much larger industrial platform. Or, or the other case could be that they actually have excess cash, but there is no avenues to redeploy this cash. Or the founder would be nearing retirement, or the family head would be nearing retirement, and there's no succession plan that is being done. In this case, the founders would be worried that whether their employees would be taken care of, or they would be worried that what would the family legacy look like under the new target, under the new acquirer. Will they come and do away with the legacy, meaning the brand, or will it be taken care of? Or in an owner operator's case who's looking to sell part of his business, they would be worried whether they will still get the same P&L responsibility or the autonomy when it comes to decision making. Now they are faced with two choices. Firstly, it's to sell to a financial buyer. Now we would have read many good cases where a PE fund or a financial buyer would come in and turn companies around, put them on the right path of profitability, right? But it comes with some constraints itself, which may not match those previous concerns that we saw. Firstly, since these financial buyers they have their own set of investors, they have to at some point exit the business, right? So they come with their own exit timelines. And also another common practices between these large PE funds globally is the concept of roll-ups, where they would go and buy multiple brands and they would consolidate all of these brands under one entity. So this can lead to loss in autonomy for some of the brands, or this can even cause a lot of integration related issues, right? But the whole idea is that they end up buying a company, then they optimize or transform these companies, then eventually they have to exit, which may not address those concerns that we saw. The other option is to sell it to a permanent owner. And here I'll just read out this quote again from Larry Mendelson, who's typically, very candid about how he does acquisitions. So he says that just because we buy a company does not mean we know how to do the management team's job better than they can. He says that companies want to sell to us because of our culture, and even when they tell people that, on the outset, that we're not going to pay the highest price, but we intend to keep the business forever and build on top of it with minimal interference. If I look at Atlas, there's a very similar, it sounds very similar. They say they buy multiple family owned businesses where the owner is about to retire. And this is typically a moment where Atlas's size or corporate cultures tends to speak in favor. And most importantly, they can go tell these family businesses that they'll build further on what they've already built. And their life's work will be incorporated into a good, well thought out structure. So again, it's very unique, right? When we saw the previous slide. So when faced with these two sort of options, and when the target company's reasons to sell extends beyond just financial reasons, beyond just getting the right valuation, when it's more about protecting the legacy, when it's more about the employees' welfare, autonomy, or wanting to be in a large industrial platform, they might actually gravitate more towards these permanent owners, even when they're willing to pay a lower valuation, right? Again, all of this comes down to the priorities of the seller. They might not care about any of these things, and they might just sell it to someone paying the higher price. But typically, when these non-financial considerations end up taking over, these are the type of companies that these programmatic acquirers actually end up targeting. So let's look at some examples. If I look at Atlas, these are just some recent examples of some acquisition deals they have done, where you can see that they've acquired multiple these tiny, small, family-owned, owner-operated businesses, and you can see the scale as well. Some of them have 3 employees, some of them have 13 and 18, 30, 36, right? But it doesn't mean that it ends here. It ends with these small bite-sized acquisitions where they target these family-owned, family owner-operated companies. They have also done bigger deals where they've targeted very similar companies. If you see some of the larger deals here, they have you can see the scale, right? Some of them have 100 employees, some of them have even 400 to 800 employees. And what Atlas or companies like Atlas do is when they buy these companies, they don't just strip the company away from the identity or the brand. They keep the brand going. They still, continue to sell under the same brand as well, which directly addresses those concerns that we saw earlier. So Heiko here has a very interesting strategy when they go and buy these owner-operated businesses. Typically, what they do is they buy around 70 to 90% of the stake in those companies, and they leave the other 10 to 30% as almost like a skin in the game in those businesses for the management. So this incentivizes the management to typically stick around and also grow the business along with Heiko. And typically over a period of 5 to 6 years Heiko tends to buy the management out. And of course, there will always be some exceptions. And these are just the typical exceptions that we would see in these programmatic acquirers. And these companies have also, grown in size and market cap over the last couple of years. So they are bound to come across these specific exceptions. The classic example is the PE-backed business, which a recent example is Heiko's acquisition of the Vencor Group, which was done in 2023. This was also the largest acquisition Heiko has done, and it happened to be a PE deal as well. So the Vencor Group, the story is interesting. They were put together by the well-known PE firm Warburg Pincus, and according to the management of Heiko, Warburg Pincus actually put together this company, modeling it around Heiko with the incentive to even sell it to a industrial platform like Hypo or a Transigm or someone like that. Another common exception are these carve-outs from these larger industrial groups. This is when a programmatic acquirer will go and acquire very specific assets from your larger industrial companies. And the thing is, since these are very specific assets, they may not be large enough to operate independently, right? So they will have to be absorbed into a specific division or a specific business segment of the acquirer. And occasionally, just like all of us, they also like dabbling in the public markets every now and then. A recent example was Atlas Copco's deal in 2020 to buy IsraVision. Here again, IsraVision was a owner-operated company. I think the promoter had around 23% stake at the time of sale. Another big example was Atlas's deal to buy the Edwards Group back in 2014. And here again, it's an interesting story because Edwards was a PE-backed firm which had IPO'd around 15 months before the acquisition. And the IPO didn't really go well. And this is when Atlas, pounced in and almost like a white knight gave a decent exit to the PE funds. And they also got a good value. They paid a decent valuation for the companies, something they benefited from. Again, exceptions I feel are very important when it comes to looking at these programmatic acquirers because we need to see how often they deviate from the core strategy or whether deviation from this core strategy even makes sense. So it's something for all of us to keep in mind when we look at these programmatic acquirers. So the third trait I want to talk about is investor savvy, and this is where all of the qualitative things that we talked about. I feel this is where it comes together on a quantitative level. So here I've just plotted the number of deals for Heiko, and the blue chart shows the average deal size that they typically do. And we see they tend to do around 2 to 7 deals per year, and the average deal size is around 40 to 60 million. Again, this is very small, right, for a company of Heiko's scale or market cap. And the average deal risk is also sort of contained. You can see the average deal is typically around 4% of the capital employed. And that being said, every now and then they do these larger deals, like in we see 2016 or 2017, where there's a bump up in those blue bars. That's when they would have done these larger deals. And most notably, the 2023 spike, that is because of the Encore Group acquisition. So similarly, if you look at Atlas, they've the deal volumes for them have increased in the recent past. This could possibly be because of the market cap of the company or the scale of the company getting larger over the last couple of years, and the average deal size that has pretty much stayed the same. It's been in the range of 25 to 45 million for all these years, and every now and then you again see a large opportunistic acquisition, like in 2014, the Edwards Group acquisition, or in 2020, the Isra Group acquisition. But on an average, the deal size here is also the deal specific risk is also sort of contained. The average deal contributes to around 1% of the capital employed, and those bigger deals would be a larger percentage. So here, like we talked about before, uh, these companies build these long-term relationships and they satisfy a lot of non-financial concerns of those companies, right? This, in a way, actually makes them an acquirer of choice almost because of these long-standing relationships. And you can see in some of the valuation multiples. So I have just plotted some of the larger deals and the valuation multiples they paid for. We can see that in many of these deals they've actually paid a much lower valuation multiple as compared to either the peers, or the valuation multiple is lower than the acquirer's own multiple itself. So if I take Atlas, for example, they try to close many of these smaller deals at 4 to 5 times EBITDA, and for these larger deals they tend to it goes into teens. Even for the publicly listed companies which they bought, for Isra Vision, they had paid much more than what they usually paid, but it's still relatively slightly lower than the peers valuation by pay. Similarly, if I look at Heiko, they try to close most of the deals between 5 to 8 times EBITDA. Again, it's very interesting. It's much lower than what you would expect many of the acquisitions to be. And the larger deals tend to be around 10 to or even low teens EBITDA multiple. Even Velcor deal, which was the largest deal, was around 13 times EBITDA. Around the time the management was saying that most of the PE deals in the space was happening at around 15 to 18 times. So again, interesting to see that they ended up, paying lower even though it was a PE deal. Now, one other benefit of being an acquirer of choice is that these companies can actually structure some of these deals or majority of the deals in their favor. This is done through the concept of earnouts, where a large payment or a reasonable amount of the payment for the deal is contingent to achievement of a revenue or EBITDA targets post acquisition. This can be any sort of target post acquisition, actually. And we see some of these deals, they actually have a reasonable amount of contingent considerations. This is a very common practice for these programmatic acquirers because of their status as an acquirer of choice. Typically, companies don't disclose it for each and every deal. They might disclose it on a totality basis. So I've just put together what is publicly available. And of course, when you're doing so many deals, there are bound to be mistakes, right? But the whole idea of the process that these companies follow and what we saw before these things, the whole idea is to reduce the number of mistakes, and that is in that way these programmatic acquirers, they've actually achieved this. If you see Atlas in the last 10 years, out of 172 acquisitions, there's only been around 7 divestments. Heiko has a very extremely good track record here. Out of 10 years, they've acquired 50 companies, and there have been zero divestments. What's even more interesting is that they've had zero goodwill written off Heiko since the 90s. And in Atlas's case, due to these 7 divestments, there has been a minor amount of goodwill that has been written off, and what it's not a huge amount. But the whole idea is that the entire process that we saw till now, the whole idea is to reduce the number of errors. So I just put together the ROCs of these companies, and ROCs has become very interesting to track, or it's a key metric to track, I feel. Largely because these companies, they evaluate M&A plan and a capex plan, internal expansion, at the same rigor, right? So in that way, our ROCs become very important to track. And we have seen that we can see here that ROCs have been at reasonable levels over the last couple of years. And every time when there's a large acquisition, we also see a dip in the ROCs. For example, in 2023, in Heiko's case, the dark blue line, we see a dip in the ROCs because of the Vencore Grove acquisitions. But we also see an immediate increase in 24 or 25. So this is also largely attributable to how quickly they can integrate these businesses, right? And again, it all comes back to the previous set of things that we saw. Even in Atlas's case in 2040, when they acquired the Edwards Group, you again see a small dip, a reasonable dip in the ROCs. But again, you see a jump in 2015, 2016, and 2017. Again, it comes back to how quickly they can integrate these companies. Again, this all of this tends to be a very good feature of these programmatic acquirers, all attributable to the things that we saw in the previous slides. So lastly, I just want to talk about this cultural trait, which is eternal. No, it's not the eternal we're all thinking of, but here the idea is to give a permanent home and to ensure continuity for the business. And we pretty much, covered all of this in the previous slide. But there's still one question that is pending to be answered, which is, what about the continuity of the acquirer? How does this culture of even offering continuity even ensured in the future? How can they keep on continuing to offer a permanent home for the other businesses? And this is solved through the idea of creating internally developed leaders in the business who can ensure that this culture of offering continuity continues. So in Heiko's case, it is a little more straightforward. Heiko has been run by the Mendelssohn family since the 90s. The family also has the largest voting right in this business. And here, the leadership has transitioned within the family, and so has the culture of the company itself. And even this Larry Mendelssohn's sons, who are Victor and Eric Mendelssohn, the current co-chairman and co-CEOs, they've been involved in the business since the 90s. So it's a very unique case because in this case, both the sons were the ones who actually found Heiko in the 90s, and then the father decided to acquire it, right? So even he is also operating through his subsidiaries. And in Atlas's case, it's pretty unique. This is a 150-year-old business, and ever since inception, it's been owned by the Wallenberg family, but it's completely been professionally operated right from inception. Then this is largely because of the policy of developing leaders internally, which all comes back to that whole decentralized structure that we saw earlier, where you give a lot of autonomy and responsibility to your business leaders, internal business leaders, and this is where it all comes to play. So we look at the company. They've had around 13 CEOs in 150 years, and only two of them actually have been external hires. All of the others have been internal hires who've been in the business for 20 plus sort of years. So since these managers gain CEO like experience very early on, by the time they rise through the ranks and come to the top, they know in and out of the culture of the company and how they do acquisitions, etc. So by the time they come to the top, they can ensure that this culture of continuity and things like that can keep on going. So it's a very common feature amongst these programmatic acquirers. We see a very similar case in other companies like Amtech or Amphenol and Turnsheim, for example. So it's this idea of internally developing leadership. It's a very good thing that comes from because of the decentralized structure they operate. Lastly, I just want to talk about India and what happens in India. So in India, we may not have these programmatic acquirers as such in the same context that we saw earlier, But again, that doesn't mean that, it's the only way of doing acquisitions or the only right way of doing acquisitions. There are many good, successful deals that have happened in India, right? And like I was saying before, there are some of the frameworks that we saw earlier, or some of the things like, these bolt-on deals and decentralization. It's also visible in some Indian companies. So let's look at some recent examples. So ITC in the last 5 years, they've done multiple smaller bolt-on deals. For example, they've acquired smaller brands like Yoga Bar or even Pasuma, which is a frozen fruits foods brand, or even 24 Organic Mantra, which is another smaller brand. And you can see, if you look at the investment column, some of them have also included contingent payments. So even these concept of earnouts, it's not a foreign concept. Indian companies have also been doing this. Next, another example of these bolt-on deals is Reliance's approach when it came to its new energy plan. So Reliance has committed around $9 billion of capex, or capex as well as inorganic expansion for its new energy investments, which includes its foray into solar, battery, green hydrogen, and fuel cells, so on. So here they've done multiple strategic investments or acquisitions, largely in solar or in battery, and mostly it's been done to secure some sort of niche technology in the space. So even concepts like decentralization is not a new concept. It's actually the very foundation of a well-known FMCG giant like HUL. So the story goes that, in 1950s, the chairman of Unilever back in London, he felt that the company is getting more and more global, but this might make the organization more slow if all the decisions are being taken all the way back in London. So his solution to all of this was to decentralize the company. And this is what he called, even back then, delegation to the endothelins. So during this transition phase, the Indian executives of HUL, who were initially just caretakers of a foreign business, transitioned from caretakers to business leaders or P&L leaders, or currently what they're called as is category managers in HUL. So all of these stories and how decentralized the structure works in HUL and how it has created many internal leaders is captured in this book, CEO of Factories. And we would also heard, right, many C-suite individuals from these in FMCGs companies, they all would have been ex-Unilever. So this is what this book actually addresses. And even the author, is true to the name of the book. Sudhir Sitapati was in HUL for nearly 25 years, and he's currently the CEO of Godrej Consumer Products. So it's a very good book on how decision making or quick decision making works in a decentralized environment. Lastly, I just wanted to end with an example in the industrial space itself. So ABB Global, the parent company of ABB India, they decided to decentralize the organization back in 2020. And this is because ABB felt that the business was getting more and more complicated, and they felt that the headquarters was involved in most of the decisions. So the CEO himself back then, he said that the matrix organization that ABB had created is creating high costs because the head office hinders business more than the value that it's added. This was actually very interesting to read, because if we go back 10-15 years before, AV was the one who actually pioneered this whole concept of matrix structure, where many divisional leaders come with a dual reporting line, right? So this was interesting to see. And the same thing was obviously echoed in the Indian company's annual reports as well. So back in 2020, if we see ABB India's annual report, they start talking about the new decentralized company. And here they say that they discontinued the matrix structure, and now the businesses will be divided into multiple divisions. So how it works is there are three business segments under which there are 19 business divisions totally, and each of these divisions will have its full ownership or accountability for whatever strategies, performances, and the resources that they're using. And even they came out with a very interesting scorecard uh, to to measure the performance of divisional managers. The managers will now be evaluated on orders. They'll be evaluated like on operational earnings and even capex and ROC. So you can see that change right now. They have to think more like owners of these business rather than just employees. So that same thought process also flowed into how ABB Global thought about acquisitions. So you can see in this con call here where Sanjeev Sharma, who was the MD of ABB India, he talks about how ABB Global will now start looking for these smaller hold-on deals, similar to what we saw earlier before in the previous slides. And he says that the global parent has also started to encourage the local Indian unit and the divisional managers in India to start looking out for these smaller bolt-on acquisitions. So let's see how this plays out because the last 2 years they haven't acquired the Indian entity itself. They haven't gone and acquired any targets, but typically these cultural changes they take a while to settle, right? So let's see how this plays out for ABB, given that it's a very well-renowned global industrial giant. So thank you for your time.
Extremely valuable information that you have shared with us.
Thank you.
Uh, I have only one question: is that there are you have shown two kind of acquirers. One is the financial acquirer, and other is niche who wants
Yeah.
acquire. Okay. So now the third one, as you said, that PEs have come into this space.
No, so you're talking about this, right?
Yeah.
So here I meant that these companies typically they go for companies who are your promoter run companies. Now they're going for companies that are also backed by PE firms. So these industrial companies are acquiring PE backed companies.
So my question is that if one or two Ps become very successful in acquiring and running company, within a short span, if they manages to sell this company to the ultimate acquirer, then do you see a scope of uh, arbitrage coming into it and hence disturbing the current environment that is set, preset? I mean, currently acquirer goes directly to the company getting X. Now this piece that there is a value, this company might require this companies and they go and buy it. So do you see that happening?
I think in a way, it actually happened over here because, like I was saying, Warburg Pincus, the whole idea of them to build Vencor was to sell to someone like a Heiko or a Transang. At that point, actually, when the time of acquisition was happening, Heiko as well as Transdam were in the race to acquire. So in a way, like you said, I think that risk is there. And also another thing is that when earlier we saw just 1 second. Yeah, so we saw this, right? Another unique thing is that sometimes some of these businesses may be actually very, very small. So it may fly off the radar of some of these private equity firms. So that's another area where these industrial acquirers have succeeded. They go and acquire these. There'll be some companies which are very small with one single product, which may not make sense for a PE firm to invest.
And of course, so they know because they already have relationship with
Correct. Yeah.
you.
Any more questions? Hi, wonderful presentation.
Thank
I had one main question. When it comes to these companies, have their acquisitions been centered around increasing the presence across the value chain or to increase their market share in their own products?
So it varies across companies. So if I look at Atlas, they don't try to reverse integrate. Most of their acquisitions have been on, trying to buy these smaller distributors or service professionals when it comes to these tiny deals. And when it comes to larger deals, it's to expand into newer technologies or get
Okay.
increased market share. So many of these segments, right, they're extremely fragmented. There could be one very well-known regional player who has very good relationships. So typically, if someone was to organically go and capture that market, it would be difficult. So they would, prefer acquiring them, or in Heiko's case, they've reverse integrate. So it's a mix of both and varies across companies.
Another thing on the chart where you showed number of acquisitions from 2000 to 2024, I think. Yeah, so if you look at this chart, I just a cursory glance, it looked like during the GFC period and the COVID period, the number of acquisitions dipped a little and then they took up. It looked like during the bull phases they tended to acquire more. Won't it indirectly mean they're acquiring at higher prices?
So it is actually a mix. If I look at Heiko, right? So what happened was in 2010 onwards, US had actually cut their defense budgets. So during that period, Heiko was able to get a lot of acquisitions done, and even Heiko's their own core business was slowing down. But if you see their inorganic growth rate, it was actually pretty high. So it might look like smaller growth, smaller number of deals that are being done, but these are all there were decent number of deals that they did during the 2010 to 2016 period. And they also often say they stay out of the market when the valuation multiples are too high, so they don't force themselves to get in. Like in 2014, for example, you would just see one deal from Heiko, right? So largely so also comes down to that investor savvy aspect. Maybe I should have covered that. Because it's the business that they run, they tends to throw out cash even during bad cycles, because either this could be because of extremely diversified product lines where someone or the other is always there's always demand somewhere or the other, and because of that during bad times they actually come in with cash and they go and acquire companies.
Hi. Hi. Thank you for the presentation. Some of these, yeah. Yeah. So some of these Indian companies have been acquiring overseas, and largely they get this valuation arbitrage, right? Overseas, you get a cheaper value. India is generous, being in high value. So, just your views, how long is it sustainable?
So I don't have a direct view on that, but you're right. I think recently, especially Indian companies have been acquiring in Europe, right? And largely because of the valuation arbitrage. And so far, it hasn't. Some many of them have actually. It hasn't worked out. These European acquisitions. So I think we'll have to see where it exactly was, because, like I said, it all comes down to, for at least for these companies, it comes down to that framework or the mindset, that thought process that goes behind these acquisitions. So I think for any if someone is serially acquiring companies, for an outsider, I feel that it'd be very good to focus on the framework or the thought process first, rather than very specific acquisitions. But it might make sense if it's a very big deal or it's a one-off deal.
I was mentioning more about a tech companies like TB or and we've been acquiring it. Market has been rewarding them with good. Okay.
as well. Number of or series of groups like Adani's, uh, and which are in frequent news, and we haven't heard that they have hived off any of the businesses. So they also seem to be following some kind of model of acquisition and expanding through that. So have you
So not in detail, like I would say, but like you said, there has been a lot of trend of Indian companies doing these acquisitions, and even the classic example is even these IT companies, right? They tend to do a lot of acquisitions. So it's just that the framework that these guys use, it is pretty unique. So that was the whole thought process, and I'm not trying to say that it's the only right way of doing it. It's just that just a unique sense of what these companies are doing.
Thank you for the wonderful presentation. I just has one question that top acquisitions, what we are seeing in companies is that they're doing a lot of acquisitions, but their core business is not growing at that pace. So when we talk about these acquisitions, are they substitute to your core business not growing that well, or are they due to your business that is there? So
So it again depends on business to business. So if I So the companies that spoke about today, they have a reasonable organic growth rate, around 6-7%. But if I take company like Amtech, for example, they also have overall growth rate of around 9-10%. But their organic growth is much lower, around 2%. And most of the organic growth comes from pricing increases. So they, like you said, they will fall under that category where a lot of growth is coming more from the inorganic growth. But again, it all for everyone, it's a business to business case. It ends up, very.
uh, one more question related to this, that when we talk since uh, one article where ITC MD was saying that now valuations in the Indian market itself for FMCG companies is really high. Um, so if all the processes that you have said they are following that and they are the programmatic acquirers, but the valuation that they are paying is really high. So what should be the thought process when we are seeing that kind of?
So I wasn't trying to say that they're a programmatic aware. It's just they've done bolt-on deals, and some of those deals were structured in somewhat in their favors to these earnouts and things like that. But like you said, in FMCG space, because of how a lot of brands have come up, and maybe because of things like quick commerce, that whole distribution linked moat is starting to reduce. Because of that, many brands have been coming up. Because of that, valuation could be higher as well, since they've all become attractive. Thank you. But again, it's very sector specific things.
Thank you, Bans.
One more, when we were going uh, on the ROC slide, the Atlas Copco ROC is higher, but the EV to EBITDA valuation of the other company is higher when we were comparing the valuation of the acquirer and acquiree. So this seems to be the contradiction.
No, so there,
Or is because industries are different.
the industries are different. So currently, if I look at aerospace, a lot of things have gone right in the last 4-5 years. So that could be the reason why the valuations are better. So mostly those 35 to 30, the 30 times earnings you see, it's mostly in those last 4-5 years. But it's mostly because of differences in the industries they're operating in. And also that ROC point, if I look very specifically to Atlas Raiko, Atlas is typically a little more conservative. That's why you don't see them throwing. They only throw around one third of the free cash in acquisitions, whereas Heiko throws around 100% of the free cash in acquisition. Depends on that as well. So they tend to be more like they try to focus on growth, but also at a decent ROC. So that could be a reason why there's a huge difference as well. So it's a mix of that as well as the industries they are operating.
Oh, thank you.
Any more questions? Good. So that's all. Thank you, Praveen, for your wonderful presentation.
This initiative is undertaken solely with the objective of educating people at large about financial concepts, sectoral knowledge, and related matters. It is intended only for general awareness and learning purposes and should not be construed as advice, recommendation, or solicitation to buy, sell, or hold any securities or financial instruments. The information and views expressed are based on current understanding and are subject to change over time with evolving market conditions, regulatory developments, and other factors. The presenter or the company they are associated with may have existing exposure or professional knowledge relating to the sectors, themes, or concepts discussed. This does not, however, constitute a recommendation or endorsement. Participants and readers are strongly encouraged to exercise their own judgment and seek professional guidance before making any financial or related decisions. This initiative should be viewed purely from an educational perspective and nothing else.